Good morning and welcome. My name's Chris Blake and I'm the Education Director of UK ALMA, which is the association that looks after the bank treasurers. And I'm delighted this morning we're going to have a session on negative interest rates and the possible implications associated with those. And delighted to introduce two fellow panelists. And so first of all, we have Colin Johnson. Colin's the Chief Product Officer at ALMIS International. ALMIS International do a lot of calculations around interest rate risk and many other things as well. So delighted to have him here. And in addition, we've got Charles Wood. Charles is the Head of Balance Sheet Risk in Treasury at Nationwide Building Society. So welcome to you both. Okay, so basically over the last few years, the economics of the world seems to have put us in a situation where inflation doesn't seem to be anywhere in the Western environment. And what that has led to has been decreasing interest rates over probably the last 30 years, actually, from sort of average in the 1990s around the 10 to sort of mid 2000s of about 5. And now with COVID-19, we find ourselves in a situation where interest rates have got close to what we previously thought was a floor around 0. But however, they look like they may start to go negative. So I think for the next 30 minutes or so, we're going to have a chat about what the possible implications are of negative interest rates. So maybe we should start on the customer impacts. So Charlie, do you think customers are really aware of negative interest rates, especially in the retail space, or are they in denial?
Hi, thanks, Chris. It's a very interesting question. I think the reality is, if you look at levels of financial awareness just more broadly, I think it's very unlikely that retail customers really get the concept of negative rates at this point. So I think it's probably less of a denial and more probably one of an understanding. I think the interesting part of all this, though, is almost how negative rates, if they were to come into play in the UK, are actually implemented. Because if you think about the purpose of negative rates, I guess from a policymaker's perspective, is really to try and stimulate economic growth. And that can be done ultimately through two different ways. One is by trying to stimulate domestic demand, supported by lending. And I guess the other one, and they're not necessarily substitutional, but the other one is really to try and avoid any appreciation of currency. And that obviously in the associated monetary sort of tightening that comes with that. And if we think about the situation, particularly in the UK at the moment, it's probably, if it does happen, it's going to be more likely driven by domestic demand imperatives. And I think that opens up interesting opportunities around how might it actually be done. So there's the traditional sort of negative policy rate, which is obviously very visible and is public. And for that to be a really effective mechanism, I think we would have to have, at a sort of industry level, and probably led by the bank themselves, a huge sort of education program, if you like, to help people understand what it actually really means and what it means for them. Because it's not necessarily that intuitive for a lot of people who've only ever probably thought of interest rates as being positive. Notwithstanding, clearly real interest rates have been negative for actually several years, but again, that's not something that typically gets talked about. But the other interesting component to that is if the focus is domestic demand, then there are other less visible ways that the bank might choose to pass on or to implement something like a negative rate. And for example, we have the TFSME scheme at the moment. It's not impossible that they might look to apply a negative spread on the cost of the TFSME scheme, if I can get my teeth in today. And that would have a similar impact in terms of driving more lending and supporting domestic demand, but would be much less visible to the wider public. And so it almost wouldn't need the same level of education in terms of the retail customer base. So in many respects, it sort of depends how it's done. But if it's done in the traditional way that we've seen in other countries so far, then I think it absolutely will need a sort of fairly widespread education program.
Right, thank you. And Colin, some would say that it could be difficult from a retail perspective to actually charge a negative interest rate, because some people may think, well, I'll just go and take my money out and put it under the mattress, or somewhere in the garden. Do you think therefore that means there could be an impact on sort of free banking,
Thanks,
or the nature of
I mean,
of a
certainly
bank's
there's
business
a lot
model
of
with its retail
questions
customers?
around what would actually happen and whether people would act differently. And when, I think as Charlie alluded to, you've got a wide raft of customers ranging from those who will be financially very switched on and have followed the debate on negative interest rates over the previous years, and there'll be those who haven't even thought about it and frankly wouldn't even realise how it would apply to them. I mean, if you think certainly in the UK perspective, the implication of free banking, in essence, there's a massive amount of money that normally sits in the banking system in current accounts and very short dated. And what has happened is the banks, through what's called structural hedging, will use that money and invest it over a longer term, even though in theory it's very short term. So banks, if you go back 10 years or something, would have been earning 5% on that, and for big banks, it's equivalent to billions of pounds of income that they were getting by getting that 5% on that money that was sat in current accounts, which of course pays the cost of the banking system. If the rate on all interest rates goes down to zero or negative, you end up with a place where that income for the banks has gone, in essence. So how do you pay for the banking system that we all have relied on? And it is a very UK centric thing where we just assume, the general customer assumes that they should have free banking, whereas of course in many other countries across the world, banking is chargeable. They're not used to this notion of you can just switch bank accounts and there is no cost to your checks, your transactions and whatever. So it's certainly something that could have an impact if the UK decides to go down that model. I mean, to date, that lost income from the banks has just disappeared, and hasn't been recouped via direct charging to customers. But it's certainly something that if rates go negative, particularly across the term structure, so that it's negative rates both in the short end and out to 3-5 years, it's something that the banks will almost certainly have to consider.
Sorry. And can I ask a question? If rates go down, or maybe Charlie can take this as well. So if interest rates on the liability side, so your deposit rates go down to either negative or very close to negative zero, is it likely to also mean that sort of people might prepay their mortgages down earlier? And especially with COVID-19, the savings rate maybe has increased over the course of the last few months. Do you see signs of that type of behaviour, a change in customer behaviour?
I think so. As ever, this is a really sort of interesting area, because there are different ways of hypothesizing what we would sort of theoretically expect from this. But clearly, none of the models have this experience built within them. But I think the key here is whether mortgage margins and mortgage rates actually follow the policy rate down. Because I think, as well as potentially an end to free banking, one of the other levers available to the banking system to actually try and protect to an extent and manage that margin is to actually hold mortgage rates where they are. And clearly it's the mortgage rate that will drive the prepayment response rather than just purely the policy rate. So I think, clearly at the moment, mortgage margins are probably more elevated than they've been for a few years now. And clearly that is in part down to the COVID-19 situation, as much as anything in terms of the impact it's had on firms' operational capacity, as much as anything else. So I think it really does depend to what extent and how quickly negative policy rates flow through into actual, reduced lending rates. To the extent that they do, then yes, I think you would absolutely expect to see some increase in prepayments. I think it would be really interesting if we do get to the point where rates go negative rather than to zero, whether that, once again, link into my previous answer around the educational side of it, whether that actually stimulates a bit of a step change in behaviour. almost like a psychological barrier has been passed at that point with rates going negative. I think that will be a really sort of interesting point if and when it actually occurs to explore. But for me, the key thing is I think it's probably too early to just automatically assume that mortgage rates will necessarily follow policy rates down, certainly in the very short term.
Super. Okay, thanks. So maybe the second question is sort of more specific to bank management rather than the customer management when you're inside of a bank. Colin, is there anything particular you see from your perspective in terms of bank management? There's lots of things going on at the moment, LIBOR reform, lots of changes to sort of accounting and hedge accounting. Are these type of things relevant, you think, when it comes to negative interest rates?
Oh, definitely, Chris. I mean, in terms of the impact of rates, it has a massive impact across the whole spectrum. I think you've talked about there are lots of things all change and interact. So, things like LIBOR reform is actually quite a good example where in the UK, the move off LIBOR onto an alternative index, and we talk about SONIA being the chosen risk-free rate for the UK. However, when you look at your bank balance sheet, things that reprice against LIBOR might not all move in exactly the same way. So, for example, a derivative that has got LIBOR might behave differently to a loan that's a buy-to-let mortgage in terms of how that actually passes on. So we might end up with transactions that are retail and LIBOR behaving differently to wholesale and LIBOR. And certainly from a negative rate point of view, if you go back to, I think it was around 2010, there was a challenge in the UK about whether mortgages that track an index could go negative because they were written at, LIBOR less a spread. And, I think the UK courts deemed that, from a tracker perspective, there was an implicit floor at zero. Whereas, of course, on the other side, if you've got a wholesale or treasury transaction, there probably won't be a floor at zero. So there could be implications for the margin, an embedded basis risk there as a consequence of that. When you get into, hedge accounting, in theory, it is just looking at the difference between the two. So it is just discounting cash flows. So, the change in fair value on one side should offset the change in fair value on the other. There might be problems with cross currency if you've got things that are relying on cash flows in different currencies, and again, slightly different rules between the different underlying index. And I'd guess a little bit broader things like the EIR equivalent interest rate calculation. You might start to see some interesting changes when you start doing that. Even things that we all day to day live in, things like net present value, discounting cash flows back to the present day. We're used to the fact that it's a smaller number. Well, it might not be. So there are lots of things for people to get used to. A couple of straightforward examples: if you had an interest only mortgage that was in arrears, one of the typical measures people will use is months in arrears on your payment. Well, what happens when rates go negative? Because that whole concept sort of disappears, because there are no arrears are negative. So I think there's a lot of different bits and pieces as it plays through that people will have to think about, that are more the intellectual debate and getting used to it, rather than per se that one specific thing. I think in isolation things will look sensible, but all of the graphs and the MI and things that people have just got used to, and some of those concepts, there will probably be some strange answers coming out of that. And I think particularly when we look at negative rates, it's whether the rate is marginally negative. Are we talking about between 0 and -1 versus rates go deeply negative? Is probably a very different concept as well, but both in terms of how it looks optically, and also what institutions will do in reaction to that.
Super. And Charlie, lots of banks, well, in fact, all banks have quite a lot of their asset side of their portfolio in what's called liquid assets now. The terminology that we use is high quality liquid assets. There's generally government bonds and cash at central bank and a few other little things around that. Are there implications for the types of the types of assets that might be included in those buffers into the future if we go heavily negative on interest rates?
Yeah, I think that absolutely, and clearly this is one of the places that negative rates is really aimed at in terms of trying to encourage banks to hold just not much more than the minimum requirement in terms of cash to actually put it to use. But I think absolutely would drive a real re-evaluation, I suppose, of the lab investment strategy, or ought to. I think coming into play there, clearly they would be looking at different classes of assets, moving down into sort of the level 2 and potentially beyond. But I think also probably as much as anything, looking at geographical diversity as well, and in terms of looking for opportunities in terms of whether it be Japanese bonds or Canada, US, whatever. Depending on the actual investment strategy you have at the moment, I think they'll have to be a more global, I guess, investment approach, just to really try and find any way possible to maintain the liquidity profile, but just minimize the cost of doing that. Because I think just continuing to do what we have previously done in the way that we've done it, liquidity will very quickly become extremely expensive. And I guess that's part of the point of the policy, to actually stimulate firms to actually lend it rather than sit on it. But clearly, any firm is going to have quite a material minimum liquidity requirement, and it's just part of our fiduciary duty ultimately to try and minimise the cost of that as much as we can. So I think there'll absolutely have to be much more diversity going forward if this situation were to play out, particularly in a very extreme negative rate environment.
So interestingly, Charlie, you mentioned that we're having to hold a lot of liquid assets for a prudential reason, to guarantee against the possibility of liabilities disappearing off the balance sheet. That's in essence becoming more expensive to do so. So I suppose the rhetorical question to Colin and yourself as well: if it's becoming more expensive and you have to recoup that cost, in essence, opportunity cost of income, then aren't we actually going to finish up having to charge more to the clients on the actual underlying loans, which in many respects sort of defeats the object of the whole point of this, doesn't it?
I think to an extent, yes. And I think that's sort of linked into my point earlier around, well, it's not necessarily the case that loan rates will come down in the way that maybe has been expected. And I think you're right that inevitably some of that increased cost will be sucked up in lower returns. But one way or another, yes, it will absolutely have to be passed back through onto the end customers, because there are lots of examples where rates have gone negative, and that hasn't been passed through onto retail deposit customers, for very good reasons, around understanding, but also just the risks of doing so, particularly if you're there's a real first mover disadvantage in this perspective, and particularly from a building society's view, where we have statutory nature limits in terms of funding mix. That's a huge threat to our business model ultimately. So yes, I think it will, but it also cuts to the heart of your view of whether negative rates really have been or will be that effective in achieving what the intention was. I'd be interested to hear from Colin on that.
I think I'd say, kind of on top of that, is it's of course very different if you're coming from a point where the banks had a very strong balance sheet with lots of capital, healthy margins, and this is margin that could be absorbed, versus a position where in essence we're still sat on the back of the reforms and the increase in capital that has come out of the financial crisis, where banks have had to strengthen their balance sheets and retain capital buffers, build them up to meet the new levels. And there aren't many banks where I mean it's not the only measure, but you look at the investors are typically sat on quite big losses in terms of the value of bank stocks. You've also had a point where to a large extent dividends have already suffered, particularly whether that was enforced or not, because of either known or expected credit losses on the other side. That just saying, oh well, it's the easy answer, oh well, it'll get absorbed, But ultimately, what that probably will mean is, okay, it gets absorbed on one side, but how's the bank going to recoup it? And then it's either, like you say, the direct costs that get passed on to your clients, cutting your own costs via shrinking your staff, shrinking your, your branch networks, all the other things, which has other, socioeconomic implications. And it's not necessarily as easy as just a purely financial decision. And so you do end up where it's that complexity of the logical financial decision might not be the one that all institutions can take, particularly, and we've seen this where other institutions have moved and you're the last branch in a town. The impact of closing that is perceived to be much bigger. And so as an industry, I think if again, if negative rates prevail as a much longer term thing, there are much bigger consequences than if it's a kind of short term and you can absorb it and see it as a, well, we'll get through there and rates return to what people will call a normal, versus if there's a structural longer term flat or negative rates, then there'll be bigger questions I think have to be answered that will become sector wide rather than single institutions. And like you say, the impact of the first move advantage, it does feel like as an industry there will have to be some kind of joined up thinking about how we do this and what is necessary to be maintained in society.
And there's an interesting point, I think, as well, in terms of, so I agree everything with that, Colin. I think it'll be interesting to see to what extent the response that banks and societies take in the event that negative rates occur as a result of this COVID pandemic, because I think there is the potential that because of the nature of the cause of the stress and the greater emphasis people are putting on community, and there's almost a bit of a sort of reordering of the hierarchy of stakeholders that a lot of banks are actually focusing on, to what extent that might shape, as you were saying, actually the nature of the response that banks take in order to manage that margin squeeze if it were to happen. I mean, clearly we might never know, but I think there's a plausible argument to say the response might be slightly different and more nuanced if it happens now than if it had been from a more of a sort of a pure financial shock, I suppose, for want of a better phrase.
Can I ask a question and on systems and infrastructure in banks? Now, we have a lot of banks have some very up-to-date systems and lots of whizzy stuff. They also have some slightly older systems as well. So there's a mix of both of those things. Can anyone comment on whether you perceive there to be an infrastructure problem with negative rates? Does it have much of an effect?
Do you want me to start on that? So as a system provider, obviously it's been thought about in terms of negative rates, but we are in the providing software for the ALM space, so you've thought about risk, and one of the things that has happened is people have had to do stresses that consider interest rate moves going negative, and in the latest EBA guidelines they've got yield curves going negative, so you've had to make sure all that plumbing works, and you would hope that most people in banks have at least considered it and they've tested their systems from that point of view. But like you say, I think the much more interesting thing actually comes down to some of those legacy systems and some of the things that are within the plumbing, especially as you start getting into things like I use example earlier, on a mortgage, your cash flow might go from being a debit to a credit or from an asset to a liability. The question when that goes negative is there coding that was built in good faith as things like error trapping to make sure that you didn't have rogue data in your system. You could easily have things that tracked for zeros and negatives to sort of go, oh, it's got a negative balance on the mortgage, that's obviously wrong. Well, now all of a sudden we might have negative cash flows. We're going, well, that's the behavior we want. So there is the danger that there is that within the systems, and certainly within anything that people are doing themselves in spreadsheet models and various things that underpin those core systems. There is the danger that things live and you don't reinvent the wheel. So something that might have been built 10 years ago, a very simple thing, might all of a sudden stop, and that might just be one part in the cog. And it's making sure that you can get down to what that one issue is through the myriad of other data, and that it doesn't just get, you know, not seen or lost, or, like I say, thrown out as an error when it's expected behaviour.
And is there Charlie, do you believe there's a sort of any legal aspect to this? Well, apart from this sort of infrastructure side, are there legal aspects to this? I'm thinking treating customers fairly angles that might go that might go with negative interest rates.
Yeah, I think there are. I mean, Colin alluded to sort of, you know, legal discussions from probably 10 years ago in terms of tracker mortgage rates, and I think it will get quite difficult, particularly if we end up in a situation where you've got corporate and SME rates maybe going negative, particularly in the SME space, but then you've also got retail rates being held at zero or just above zero, and you know, you might well have customers who've got accounts for both reasons looking at it quite reasonably, saying, well, hang on a minute, why are you charging me for this one but not for the other? And then the interplay, obviously, again, in terms of what's happening on the mortgage side, and you know, rates, you know, on a retail loan, yes, there's an expectation that, you know, zero is the floor, but is the zero the floor on the reference rate and you can still charge the spread, or is it the overall rate? And so there's lots of different nuances and implications on this. And I think the reality is many T's and C's and contracts, probably, particularly the old ones, probably don't always necessarily talk to this terribly well. So if it happens, I imagine we will probably have a few test cases ultimately across the industry. But I think, again, looking at the experience of other countries and firms in other countries where this has happened, then clearly there is a way through it, because, you know, in most instances, I think, apart from maybe one or two, retail deposit rates haven't gone negative, even when policy rates have been negative for several years. So it's one to be, you know, keep a close eye on and to actively think about, but I don't think it will ultimately derail the whole thing. I think one of the other interesting components there is really, I think it was a great comment from Colin in terms of sort of data quality attributes and how that might all change. But then equally, when it comes to models and understanding customer behaviour, no one, at least from a UK context, has any model that can be built or referenced on similar instances. So there's going to have to be a recognition that actually, you know, the models will only help you so far, and they will only ever have to be a sort of an input into a conversation, a decision around behaviour, rather than a sort of a direct, okay, well, if this is what the model is saying, this is what we'll assume. There's going to have to be a lot more sort of judgment-based assessments applied.
Yeah, do you think there's any chance that it could change the nature of deposits? So maybe the banks will look to take longer term deposits from their client base rather than shorter term. So we move to a more contractual liability base on a balance sheet. Would that be a possibility?
I think, yeah, I mean, I think it's quite possible. I mean, again, it depends on the extent to which it happens, because I think without that, then clearly the differentiation between sort of savings and current accounts gets quite undermined. I mean, to an extent, it sort of has been already. And so, as Colin alluded to earlier in the perhaps structural hedging, you're going to get probably quite a lot more flighty balances generally. So I think absolutely firms will look for any way to try and lock those balances in a little bit longer in order to allow them to try and still generate some sort of maturity transformation benefit, which is, you know, obviously the linchpin of banking in many respects. I think, you know, as ever, that will come down to what will that cost, or what will it take to persuade customers to actually lock in for that longer period of time. I wonder whether we might actually see more of a return in the retail space to a notice type account rather than a more sort of traditional fixed rate, fixed term product. Because I think, you know, when the curve is very flat, it's quite hard to get a differentiation between instant access notice and fixed term. But if you're trying to lock in, in an environment like that, I think probably going for a notice account would probably be a little bit cheaper than fixed term. But I agree with you. There will, banks will, I'm sure, and builder sides will be looking to find some way to move slightly further away than just, heavily reliant on instant access.
I suppose the final area would be a little bit of stargazing, really. What do we think where might this all go in the long term? Colin alluded to it, talked about short term, but in the long term, do you have a view as to what the implications could be, either down or up, given sort of these situations? Colin?
A trading view, excellent. I think the interesting thing, I did say in terms of whether it's short or long term, and you sit and people have, I've certainly lost track over the last 10 years of the number of people who have kind of said, oh, well, rates are at an all-time low, they can only go up from here. And, they're talking about the term rates, the 5, the 10-year rates as much as the overnight. And the number of times you've done that only for, you get a bit of volatility, but 12 months, 18 months later, you sit and you go, and you're now 100 basis points lower than where it was. And that's happened kind of again and again and again. And we're again in the same point where it's like, well, rates can only go up. And, part of that is, we only think about what we've got in that history of our experience. You've also got, some of the regulation, I mentioned the EBA 6 shocks earlier. Well, they force you to do these 6 shocks and up and down, but they themselves have embedded a floor, which I think is -1 in the overnight, and it sort of amortizes off to 0 in the 20-year, which again reinforces in people's mind this concept that rates can go negative in the short term, but not the longer term. So, there is that kind of inbuilt. Will it? Logically, you want to think so, and I think Charlie covered a lot of this in terms of the complexity of the behavioural understanding, what it might mean to people, which is so important for the people managing the balance sheet. It is not what is contractually on, the product that people buy. Is what actually happens, and it's that behavioural side. And you asked the question, good question yourself, which is, well, should we go longer to lock it in? And the sort of answer is, oh yes, that's great, but we might end up with more notice accounts at a time when we ourselves are sitting and going, and we don't know what the behavioural consequences will be. That sort of level of de-risking, it's difficult to square the circle on that. So what would I say? I think I've kind of lived in the world that rates are lower for longer for a very long time, but it does feel like there is a real danger of all of the unintended consequences or the intended consequences of not just the response by central banks, but everything trying to force the money to move again, driving unexpected inflation and seeing that inflation go up, where the natural answer will be higher rates in response to that. So I'd like to think, I think I'd like to hope that we do get higher rates. Let's be an optimist and say it's short term and we go back to what someone can call normal, and whether that means 3%, 5%, 10%, who knows? But it'd be a much nicer thing than to say we're going to keep seeing an ever declining thing of rates going lower and lower until at some point we just stop using money because it's all a bit too hard.
And can I ask a sort of maybe a final question of Charlie? So, we've talked about this from a customer perspective in terms of, interacting with their banks and the bank infrastructure and legal perspective. But what about, people's future? Are there real implications here for people's future? Pensions and, asset returns in saving? Is there any point in saving at all? And the intergenerational thing that goes with finance, and that what finance is looking to achieve. Have we sort of hit some possible limits that mean that people's real underlying behaviours will change, or the impacts of this will be felt in the slightly longer term? Charlie?
Yeah, I think there is, and I think it's probably partly negative rates and partly actually probably a broader trend anyway. I think it's been well documented that the current generation or generations are probably going to be the first in a while that will end up if you like, generating less wealth than their predecessors. And I think it does have big implications for the savings dynamic and people's attitude. And I think, typically, the majority of savings are held by the sort of elder members of the population because they've had the time to accumulate that wealth and, earn the money and all the rest of it. And there is a really interesting question in terms of, yes, there's a sort of the endowment and sort of inheritance effect, but actually the generations that are coming on behind them aren't generating the same level of savings that they did, partly because of the broader economic environment, partly because of, to an extent, previous generations were quite lucky in terms of, the housing market and the wealth that was created that way. But I think there are big societal implications. And I think the other component of this as well is, and this is a big part of why I think rates will stay very low for a very long time, is that, we will get through the COVID pandemic. There probably will be a second wave, at least. Nearly every pandemic there's ever been has had more than one wave, but we will get through it eventually. But then there's going to be, a very long, slow fiscal drag from the fact that at some point we are going to have to start to pay back some of the borrowing that's been put in place. Now, some of it will probably be inflated away, but taxes are going to have to rise to some extent and probably stay higher than they otherwise would have been for quite a long time. So I think that it again starts to play into the ability of, the generations, the young people starting their working career now, their ability to actually create and generate the wealth that they need. So there are long-term implications of this, and I think it's one of it's difficult to foretell precisely how that will pan out. But I think the one thing I would pretty confident of it, I think rates are going to stay very low for a very long time. Whether they actually go negative and stay negative, I'm in the camp of I'm not convinced that negative rates really work in terms of serving the purpose that they were intended to. And I think if you look at the countries that have gone negative, not a single one of them has been able to come out from having negative rates, even though they've had them for 3, 4, 5, 6 years. And that doesn't necessarily fill me with confidence that they really achieve what they're intended to. I think it just resets the norm. So I'm not convinced that effective, but I think we'll be at zero or very close to zero for quite a long time.
Yeah. Okay, super. Well, it does seem like we're in sort of unprecedented times. There's plenty to think about, and I think both Colin and Charlie, thanks very much for your time and thanks for your insights. So we're all going to go away and consider some of these things, and it could well lead to lots of treasury transformation in the future. So thanks to both of you. And have a nice
Thank you.
Thanks, Chris.